I'm Steve. If you've ever felt completely lost staring at a Forex chart, you know exactly how frustrating it can be. Well, today we're going to put all those puzzle pieces together. We're going to build a complete, repeatable blueprint right from scratch. Let's dive in. This really hits on the single biggest mistake I see traders make day in and day out. They're zoomed way in on one time frame, and they are completely missing the big picture. You see the tiny ripples? Sure, but you have absolutely no idea which way the tide is flowing. And let me tell you, that is an approach that leads straight to confusion and to losing trades.
So what's the fix? The solution is what we call a top-down approach. Now, I want you to think of it like using 3 different maps to navigate a journey. First, you've got the global map to see the continent you're on. Then a regional map for the state. And finally, a local street map to find the exact address. See? Each layer gives us more crucial, more detailed information.
So here are our 3 maps for trading. The daily chart, that shows us the tide, the major overarching trend. Then we have the 4-hour chart. This shows us the wave, and this is where we identify the really significant floors and ceilings. And finally, the 1-hour chart. That's for our entry. It's the map we use when we're ready to pull the trigger with real precision. Okay, so before we do anything else, and I mean anything, we have to know which way the big money is flowing. We don't ever want to fight the market's current. We want to ride it. And to do that, we need a simple institutional filter that tells us just one thing. Are we looking for buys or are we looking for sells? And the single most important tool for this job, it all comes down to this one number, 200. We're going to apply a 200 exponential moving average, or EMA, to our 4-hour chart. Now, all it is an average of the last 200 price points that gives a little more weight to recent data. I want you to think of it less as an indicator and more as a direct proxy for institutional sentiment. I call this the institutional line in the sand, and for a very good reason. The big banks, the hedge funds, they use this level as a general guide for their own positioning. Our job as retail traders isn't to fight them. It's to simply trade on the same side of the line that they are on. It's that simple.
So here's the crucial point, and it's brutally simple. If the price is trading above this line, we are only, and I mean only, looking for reasons to buy. End of story. And if the price is trading below this line, we are only looking for reasons to sell. This one rule, this will keep you out of so much trouble.
All right, let's make this real. Imagine the Euro USD is trading right now at 1.1635, okay? And let's say the 200 EMA on our 4-hour chart is sitting down at 1.1500. So what does that tell us? Well, it tells us the price is above the line. It tells us the institutions are bullish. And it tells us that we should only be scanning the market for buying opportunities. See? We let the line do all the heavy lifting for us.
Okay, so we have our trend direction. Fantastic. Now, where do we actually look to enter a trade? In the stock market, very specific price points can matter. But in the absolutely massive Forex market, something else takes precedence. Big, psychological, round numbers.
Levels that end in double zeros, like 1.1700 or 1.1600, we call those big figures. It's all about human psychology. Banks and major institutions, they don't place their massive orders at some random decimal point. No, they park huge blocks of orders at these clean, memorable numbers. And what that does is it creates these incredibly powerful natural barriers in the market.
And that quote really says it all. You have to understand these round numbers are the true battlegrounds where armies of buyers and sellers fight for control. So when the price approaches one of these levels, you should expect a reaction. Go ahead and mark them on your chart with a nice, bold line, because they are the milestones that truly matter. All right, we've got our direction from the 200 EMA. We've got our key levels, our battlegrounds from the round numbers. Now we just need the final piece of the puzzle, the precise signal to get into the trade. And for this, we drop down to our 1-hour chart.
So how do we find our trigger? Because we never, and I mean never, just blindly buy or sell when the price hits a round number. We wait. We wait for confirmation. We need the market itself to give us a signal that the level is holding and that it's finally time to act.
The answer is a beautiful thing called confluence. It's when multiple factors align perfectly. What we're looking for is a powerful candlestick pattern to form right on our round number. Now, this could be a hammer, which shows that buyers are rejecting lower prices, or maybe an engulfing candle, where the buyers completely overwhelm the sellers. When you see one of those patterns at your level, that's the market flashing a bright green light, telling you the floor is holding.
Look, forget about cluttering your screen with a dozen different indicators. Effective trading isn't about complexity. It's about clarity. It's about having a process. What we've just built here is a simple, logical blueprint that you can apply to any market on any day.
So let's recap the entire method one last time. Step 1. Go to your 4-hour chart. Use the 200 EMA to find your direction. Are we buying or are we selling? Step 2. Mark the major round numbers on your chart. These are your zones of interest. And step 3. Drop down to the 1-hour chart and wait patiently for a confirmation candle pattern right at your level. Direction, level, entry. That's the blueprint.
So here's what I really want you to take away from this. Stop trying to predict the market. Instead, build a map of probabilities based on institutional direction and these key battlegrounds. I'm Steve, map your market, and I'll see you at the open.